Introducing myself, Rajiv is the name, a chartered accountant from the 2006 table. I am a practicing chartered accountant and at the same time handling these sessions for students. And my areas of interest, the subjects that I'm handling are income tax and corporate, economic, business and securities laws for the intermediate and the final stages for all the three professional institutions of the country, the CA, the CMA and the CS institutes. My topic for discussion today, the topic that I've selected is sections 128 to 138 of the Companies Act, dealing with books of account and the financial statements. Technically, the chapter is called the Accounts of Companies. So, dealing with this area on the books of account and financial statements, I wanted to focus on the intricacies of the provisions of the chapter, what the Companies Act provides for in respect to books of account, what books of account are to be maintained, where they are to be maintained, how they are to be maintained. So we will be connecting the Companies Act 2013, section 128 to 138, the companies, accounts of companies rules, accountancy, financial management, income taxation, correlating all of them together, knitting it up and analyzing the legal requirements or provisions relating to books of account and financial statements to be maintained, prepared or presented by a company. So the section range that we are dealing with is 128 up to 138 of the Companies Act and the accounts of companies rules. Now, dealing with the books of account and financial statements, what we need to fundamentally understand before we come into the legal intricacies is the distinction and the relationship between them. What is the difference between books of account, although very elementary, and the financial statements? What is the relationship between them? What is the difference between them? Where does one end and the other begin? And how are they correlated with other subjects that we need to handle, like income tax or financial management, accountancy and so on. So 128 to 138 will lead us through both books of account. Remember, it is books of account and not books of accounts, which is a common mistake made. Books of account and the financial statements of a company, to be specific. Now, I would like you to be picture perfect here with your etymology. Books of account are kept or maintained by a business or a company. On the other hand, financial statements are prepared and presented by a company to its members, to the registrar of companies, to various stakeholders for that matter. So when it comes to books of account, I would like you to use the terminology keeping or maintaining books of account, the elementary part of the accounting cycle. When it comes to financial statements, they are prepared and presented. Incidentally, section 128 deals with books of account and 129 to 138 deal with financial statements. Of course, with a lot of other clutter in between, like the NAFRA, the constitution, functioning, responsibilities, obligations and authorities under the National Financial Reporting Authority, accounting standards, reporting standards, internal audit. There are so many other provisions also which have got interspersed in this range from 129 to 138 dealing with financial statements. So 128 solely and wholly focuses on books of account, and 129 to 138 of the Act deal with financial statements, finally ending with the requirements and provisions relating to internal audit, 138. So before we come into all those corporate legal perspectives, I want you to get clear the elementary distinction between bookkeeping and accountancy. How does that intermingle? What is the product? What is the raw material? Bookkeeping and accountancy, and I don't want it to restrict it to the basic definition, because definition does not actually serve any purpose. Bookkeeping is the art of recording business transactions in a set of books. Yes, fine. But the relationship between bookkeeping and accountancy, which is more essential here, is what I'm focusing on. Now, coming to that distinction or the relationship, bookkeeping versus accountancy or accounting. Everything starts with a business transaction. You have a business transaction entered into. Credit purchase of material, payment to creditors, taking a bank loan, depositing some amount of money with the bank, purchase or sale of a fixed asset, any business transaction. A business transaction enters the journal, verbalizing it as journalization. From the journal, a transaction percolates to the ledger. Although we don't say ledgerize, it is posting into the ledger. After all journal entries are posted into ledger, there is a trial balance which signals the arithmetical accuracy of the bookkeeping treatment until that stage. So the trial balance, the agreement of the trial balance is a reflection of, it's a symbol of arithmetical accuracy. From the trial balance, the financial statements are prepared. And when I say financial statements here, I am referring to the revenue statement, P&L account, and the financial statement, balance sheet. Of course, I agree, I acknowledge, cash flow statement as per the definition, strictly speaking, is a part of financial statements. But for my purpose here, I am just delinking it. So the financial statements are prepared out of the trial balance, or financial statements have to be prepared from the trial balance only. The financial statements will lead the business to prepare the flow statements. And when I say flow statements, it is the cash flow statements and the fund flow statements, serving different purposes, of course. That is financial management. Once the fund flow statement is prepared, the accounting cycle is complete. Whether it is financial accountancy, management accountancy, advanced accountancy, not so advanced accountancy, whatever. That cycle is completed at the climax of the fund flow statement. They are basically these two statements: MIS inputs, management information systems. After the accounting cycle is done, the financial statements are approved by the board of directors. Now we are focusing on a company exclusively. Whatever is done until now is an activity carried out by any business, whether it's a partnership, a cooperative society, a Hindu undivided family. So in the case of a company, once the flow statements are prepared, then the financial statements are approved by the board as they are prepared and presented by the accounts department. Then comes the audit by the auditors. And today we have 3 different audits statutorily required: a cost audit, a secretarial audit, and an independent audit by a chartered accountant. Apart from maybe an internal audit as mandated by the Companies Act. So it is audited by the auditors, after which the financial statements are adopted at the AGM of the company by the members, the shareholders of the company. As they stand adopted at the AGM, the same financial statements are filed with the registrar of companies. We technically call these 3 as the 3 A's of financial statements. Approval by the board of directors, audit by the auditors, adoption by the members, and then filed with the registrar. That signals the burial of the financial statements, of the profitability, of the financial position, of the flows for a financial year in respect of a company, however good or bad. So once it is filed with the registrar, you can call the financial statements of a financial year as done and dusted. So this is the sequence. I started with a transaction and finally ended up with filing the financial statements with the registrar in the XBRL form as mandated by the Ministry of Company Affairs today for companies. Falling in certain categories, of course, it is for the big companies. Now this is the cycle or the sequence of activities or procedures. How do they link up? How do they combine together? How do they amalgamate? Look at these 4. The transaction up to the trial balance stage. That is bookkeeping. The preparation of financial statements is accountancy. So accountancy starts where bookkeeping ends. This is management accountancy or financial management. Preparation of the flow statements. So bookkeeping leads to accountancy. Accountancy leads to management accountancy. Management accountancy leads to company law. So I take off from bookkeeping. I end with company law, filing it with the registrar of companies. So this is the distinction, this is the relationship. I have linked up 4 of our subjects: bookkeeping, financial accounting, management accounting, and finally fructifying into company law. Now it is necessary to understand this skeletal structure first before we can take up corporate law provisions. SEBI is involved. We have a lot of these guidelines or regulations dealing with them, especially the SEBI LODR, listing obligations and disclosure requirements regulations. So in order to have a clear background of those legal perspectives of bookkeeping, accountancy, it is necessary to get this dichotomy first. So how we started with bookkeeping. Now I suppose you're clear. You know how to answer the question. the distinction between bookkeeping and accountancy as far as legal provisioning is concerned. Bookkeeping transforms into accountancy, accountancy transforms into financial management transforms into company law. So with that little background, I propose to end this session. We will take up the remaining part, the legal provisions, the corporate law angle, in our next session. Thank you.